Welcome back to the program. We're joined in the second half of the program by fellow certified financial planner and CPA and also certified financial fiduciary, Kristin Kalley. Welcome to the program.
Thank you, Joel. Happy to be here.
How are you doing this morning?
Pretty good. What about you?
Ready to talk about some interesting tax stuff that, we were on the show together a couple weeks ago, talked about a big change for the year 2022 that people are going to certainly need to know about, and we're going to recap that again for our listening audience today. But you attended a sort of a tax update, if you will, this past week as well. Tell us a little bit about that one.
Mm-hmm. Yep. So we heard about some new legislation that's going to be in effect for the 2022 tax year. So things like the energy credits, also some other things like that. So we're going to touch base on a couple of those and see if they might impact you.
A little bit more clarification on some of that stuff that has been on the books, that came on the books with the Inflation Reduction Act back in the summer. So a little more clarity, a little more, the IRS has issued a bit more guidance on that. So got some interesting stuff to talk about with our listening audience this morning. So welcome into the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's most listened to radio program, coming to you on a host of channels throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out over there as well. My name is Joel Garris. I'm joined by Kristin Kalley. We're with Nelson Financial Planning, where our team stands ready this week to help you change your life with a successful and cost-effective financial plan. So let's recap that conversation about some of the new tax documents that are getting generated out for individuals that have, kind of these side gigs or these side businesses.
Mm-hmm. So that's the new rules regarding the 1099-K. So this is for third-party payment processors, so apps like Venmo, Cash App, PayPal, things like that. So they now must report payments of more than $600 collected per year. So that could come to you in a 1099-K by January 31st for some transactions you may not have even considered.
And that's going to be a brand new tax document, and things that you probably would have done in the past, like if you have event tickets. I know a couple of weeks ago on the program we were jogging back and forth about Taylor Swift tickets being a gain versus the Magic not being a gain when you resell them, and what the tax implications are on that. And it's pretty different.
Yep. So kind of depending on what you use these platforms for. So if you're just doing it for personal transactions, splitting meals, things like that, that's a non-taxable transaction, but you may still receive a tax form. So just kind of keep an eye out for it. But if you're using it to resell tickets, then that's kind of more of a reportable transaction. So you have to report the gains, but unfortunately you can't take personal losses on your tax return.
Taylor is taxable, the Magic or not is the takeaway on that.
Yeah, unfortunately.
Wow. Okay. So, and that's true then also for folks that are also kind of engaged in businesses as well, right? Right. You might have had a little bit of a business on your Etsy or wherever, and didn't really have to worry about it. But now you're going to have to worry about it.
Just kind of, if you have a business, just make sure you're not double counting income. So if you've already included it and then PayPal or Venmo sends you another form, just make sure you're not double counting.
Because the burden of proof is on you.
Exactly.
That's that's going to be the frustrating part on this, is that people may say, well, I was with a buddy and or whatever the case may be, but still the burden of proof is on you. So if that Venmo, that Cash App generates a tax document, that it's on you to make sure that it's trued up correctly with the IRS.
Yeah, that's right.
So that's what we talked a little bit about last time. So just a little bit of a recap for our listening audience on that. Let's talk about some of the bigger changes that are happening for 2022. And I guess one of the first ones has to deal with what we were talking about earlier in the program, higher interest rates. So how does that impact the taxpayer?
Yeah, so one of the other changes that's going to impact a lot of us is inflation pushed the underpayment penalty from 4% to 6%. And then going into 2023, it's actually going to be 7%.
Wow. Okay, so that's a pretty significant impact in terms of that cost. So how does that affect people? Who should kind of be aware of what's going on there?
Kind of most of us. So just kind of make sure that your withholding is enough, because that that 6% penalty is going to apply on that 2022 tax return you file, and then moving into 2023, the 7% is going to apply.
So if I'm coming into April 15th and I'm owing a bunch of money, then I just need to be a little bit more mindful of that. I think in years past, when the interest rates were crazy low, it really wasn't that big of a deal.
Right.
But when it goes from all the way up to like 7% for next year, well, then that'll get your attention.
Yeah, so kind of just check your withholding. So if you're a W-2 employee, there's an online website with the IRS that helps you kind of figure out if you have enough. And you do have some time to make up those withholding payments before the end of the year. And then on the other side, if you're a contractor, just kind of take a look at your income. You have until January 17th of 2023 to make your fourth quarter estimated payment.
And then for your retirees as well, they need to make sure that the tax withholding that they're doing on withdrawals, whether they're from an IRA, and unfortunately, a lot of people are finding that their Social Security is taxable, so they may need to adjust that as well.
Yes.
Otherwise, the cost starts to get a little bit more significant than what it has been in the past. Again, directly correlated to interest rates and higher interest rates. Yep. So we'll shift gears and talk about charity.
Yeah, so this is another change. So for the past 2 years, everybody that did not itemize their deduction could take a charitable deduction. It was $300 for single filers and up to $600 for married filers. So that deduction is going to be gone on your 2022 tax return. So not a huge impact because it only got you, even if you're at the highest bracket, maybe a $100 or $200 tax benefit. But the kind of bigger change is for those that itemize their deductions. So they used to be able to write off 100% of AGI, which is your adjusted gross income. But now that is limited to 60%.
So that's the traditional threshold. So that run up to being able, so let's say you made, in a particular year, you made $50,000, but you were fortunate enough where you had assets and you wanted to make a donation. And so that was going to be limited to a certain percentage of that adjusted gross income. For a couple of years, you were able to do all of it. Now we're back to sort of the traditional formula.
Right.
So then what are some of the ways, and because I think the elimination of that $600, $300, to your point, it didn't really materially have a big tax impact, but I think it was more the philosophical statement, right? That if you do make a gift to charity, you're going to be able to write it off, whereby with the new standard deduction levels, very few people wind up getting that tax deduction for that charitable contribution these days.
Yeah. So what they say is the best way to get a benefit from your charitable contributions is either make it over the standard deduction or kind of bunch your deductions. So kind of make more contributions in a year that you know that you're going to have enough mortgage interest, property taxes, medical expenses to get over that standard deduction number.
And so what that means is, like, right now, if I know I'm going to make a charitable contribution, still make a charitable contribution for this year, 2022, but I know also I'm going to make one in 2023 to the same organization, we'll say church or whatever the case may be, then maybe I do both in now, and then that way, because I've bunched them together in the same calendar year, then I might get the ability to make a better tax deduction on that.
Right.
So that's the concept of kind of bunching them all together. There's a couple of other concepts, though, that you've got that deal with making good decisions involving charitable contributions.
Yeah. So if you have a long-term appreciated asset, such as a stock or something along those lines that you've held for a while that has just grown tremendously, what you can do is actually donate that entire asset to a charity, and you would not have to pay any of the capital gain tax on the appreciation. And you can also take the charitable deduction. So it's kind of a two-part benefit to it. And then there's a third benefit that comes in because the charity could turn around and sell that asset, but charities are tax exempt, so that income wouldn't have to be reported. So
a great way to do that and avoid the gain and also get the deduction as well. There's a flip side on that one, which we'll hit right after these messages. So stay tuned with us through the break. This is Dollars and Cents with Joel Garris and Kristin Kalley, talking a little bit about some of the tax changes that are occurring this year and looking ahead to next year as well, here on Dollars and Cents.